Paul, I liked your guys' conversation on futures this morning. And you guys were talking currencies in dollar. As it pertains to crude today, it seems like this was a tweet-driven market, though. Didn't really respond to any tariff read-through from this morning. What did you make of this response?
No, I mean, when you take a look at really the crude price, the crude was the main culprit, if you will, or the casualty of the tweet. Really, when you look, though, at the dollar was reacting more to the trade discussions. We saw the equity markets race higher when it looked as though we were going to push that off for a little bit and not be a hard deadline of March 1st. And the dollar sold off. So, you know, as I mentioned this morning, the dollar's kind of stuck betwixt and between right now because the U.S. economy is one of the better economies around the globe. But interest rates don't look like they're going to be rising anytime soon here in the U.S. So you've got countervailing forces, and part of the reason why the dollar's been stuck in this fairly narrow range between 95 and 97 for quite some time now.
Yeah. You know, when we look at the response, I mean, are we getting a taste here of maybe which assets will respond and to what degree to some breakthrough on the trade front, or do we have to be careful about projecting today? I mean, I think it is pretty interesting because we actually have information, which is the delaying of the hike for the tariff rate. You look at stocks, and they seem to like it, but as yields climb a little bit now, you've got some of the interest rate sensitive stuff weighing on the U.S. stock market. You've got, you know, crude that's taking its cues from the OPEC tweet. I mean, are we able to discern anything meaningful today, Paul?
Oh, I think so. I think the big winner here, I think, is technology. Certainly, it was leading overnight and into this morning, and it's still really ahead of the market so far today. The international market's doing very well, so we're going to see the dollar do very well here, or dollar come off a little bit. I think that's going to be a big boost for the international markets. Emerging markets are certainly well ahead of the S&P here. So those are a couple things that we're looking at that I think you are seeing through the markets today.
Yeah. Now, as we were mentioning in the last block, another tweet that came out here late in the afternoon about tariffs. Now, what are you looking at for the S&P 500? What are you looking at for stocks, just in terms of the degree of the comeback? Paul, I know you grace the charts every now and then to see what information they tell us. What do you think?
Yeah, you know, it's interesting is we've had such a huge rally. I think if the markets were to continue at this pace, we'd be over 5,000 on the S&P by the end of the year. But right now at the 2,800 level on the S&P was kind of where the market stopped early in November a couple times, and then back in early March last year. So we really need to clean the 2,800 level to see the markets test the old highs at 29. One bit of good news, though, if you look at the market, the internals look really good. The advanced decline line is a new all-time high, so we're getting very broad participation, which we weren't getting earlier last year. So I think the fundamentals, or at least the technical underpinnings of the market, look pretty good here and should be allowing the market to generally trade higher between now and the end of the year.